Good morning, Hedgeye Nation, and welcome to another episode of Sector Head Spotlight. Today I have the pleasure of the one, the only REIT Rob, otherwise known as the Honey Badger. So it is the REIT Sector Head Special today, and just want to thank him for joining us. It's been, it's earnings season, so it's quite a busy time for all these analysts here at Hedgeye. But I want to give you a big thanks for taking some time out this morning to come sit with us.
I still don't know exactly where that. Or who came up with that nickname.
Honey Badger?
Yeah, it just like kind of appeared. It was. I promise it wasn't me. Like I didn't do it.
The Honey Badger, I believe, was the one, the only Rob Milburn came up with that bad boy, and I think it's a very fitting name for you. A little scrappy badger, but
just a royal pain in the ass.
exactly. And I'm sure we will review the stock that got you that nickname. But before we go into that, just wanted to remind everybody kind of the rundown here. We will do a little bit of Rob's background, then we'll jump into his process, and then finish it off with some key themes that he finds important or wants to convey to Hedgeye Nation for kind of first half 2023 or all year long. So we'll. With that, I think, why don't we,
sure.
You're relatively new to Hedgeye, but I know we've come up on your 1 year, maybe 1.5 year, 2 year anniversary.
2 years in.
2 year anniversary. 2 year anniversary.
What's today? Today's the 9th.
9th, yep. Yep, that's correct.
So T minus 19 days, I'll be here for 2 years.
Amazing,
yeah.
Amazing. Feels like yesterday the announcement happened.
Yeah, and it's funny, like just by way of, make sure I just go through the background.
Yeah,
sure.
Yeah.
So I went to NYU, grew up in New Jersey, huge sports fan, as you always see me, more often than not, you'll see me with my hat on. Lived a stone's throw away from Manhattan, went to an all-boys Catholic high school called St. Peter's Prep in Jersey City, graduated from NYU undergrad business school in '07, and while I was there, I was actually interning at a kind of like a hedge fund in name only. It was really a long-only investment partnership that called itself a hedge fund. But like if for folks who remember back then, the flavor of the cycle was like, long only or activist long only with like a SMID cap kind of focus, and the easy layup for a time was find your like SMID cap retailer or other company with owned real estate that could be leased or sold or monetized in some way, and then like the idea was to just free up capital or buy back stock, and then separate those entities and off you go. So that was kind of it was called Barrington Capital. That was my first exposure to real estate, and I was interning there the 2 semesters of my senior year. Long story short, was fortunate enough to get an offer, joined like pretty much right out of school, and within 6 months, the phone blew up. It was actually a real eye opener because what the hell did I know, right? Like I didn't really know what the hell I was doing, and you learn a lot about like what not to do, and in a situation like that, the biggest kind of eye opener for me was, first of all, you're not a hedge fund if you can't hedge. Like I mean that literally. Like in the fund documents, we were not allowed to short. Yeah. So the only way to mitigate risk or to manage risk is to manage how exposed you are on the long side. And so if memory serves, around the time that I joined full time, we had this big influx of money from these JP Morgan feeder funds in Europe. Where have you heard this before? Yeah. And so you go from 60% invested down to 20, and all the analysts are having trouble finding ideas. Usually that tells you something, but like your LPs are like, hey, we're paying you fees, like put this stuff to work. And moral of the story is we made Dillard's, one of McGough's companies, our biggest position at like $35, because for those who aren't aware, they, unlike most department stores, many of which have gone by the wayside, they own 70% of the real estate portfolio. But like it was deceptive because in that arrangement, you learn this as you go through the research process. For anchor large box retail in a mall, usually the mall owner has a right of first offer to at market value to like take the real estate back, and so it puts a cap on the actual like realizable value of the real estate, and then like concurrent with that in August of 07 is when the credit market started blowing up, like well ahead of the S&P and the Dow, like which continued to rise through 08. You know, it went from 35 to like $5 or something and just blew up the fund. So like I was kind of out there, you know, I was terrified. Like, what am I going to do? You know, this is a disaster. Decided to study for the CFA to get the resume up, you know,
bolster it a little bit,
Yeah, and like I bounced around between a couple jobs and got my first sell side job in, I think it was the fall of 09 at Cowen, and I was actually covering retail because like I had spent a lot of time analyzing retailers, and just wasn't for me. Wasn't digging it, and you know I was fortunate enough to meet a guy by the name of Smedes Rose through a contact who was at KBW.
Okay.
He's now at Citi, lodging analyst. Awesome guy. He gave me my first REIT job, and I joined his team as an associate covering the lodging and the storage REITs.
Cool.
Did that for about a year and a half. Met my wife, you know, on Match.com. Interestingly enough, I'm like, back then you couldn't say that. Now you're like, it's fine.
Yeah.
And you know, KBW sold itself to Stifel. I went and did banking for a couple of years at Houlihan Lokey for about 3 years. Found my way back. It just got totally burnt out. Life was just, it was great. It was a great experience because you learn the other side of the house.
Right.
And you learn a lot about like, you know, the process of executing transactions and like how they, you know, the intricacies of that.
Sure.
And it was also very restructuring focused. So like got my hands on a couple of like special situations, which is really valuable in real estate because they pop, it's a highly levered space. It pops up all the time.
Yeah.
Found my way back to the sell side, worked with this guy named Steve Sakwa for a couple of years. Cool. And then finally went to go work for a REIT before Hedgeye called Paramount Group. That's a, you know, now it's probably about $5 billion in total market cap, CBD office REIT in Manhattan and San Francisco. Great experience. COVID hit, destroyed the office market. Just didn't want to work in New York anymore. And I was fortunate enough to run into Jonesy.
Really?
Yeah, like funny story. So like I you know, I live 8 minutes away, and you know, I was looking to switch jobs. I just didn't want to work in the city anymore. It was really a drag, and I was fortunate enough to find it. The Hedgeye was looking for a REIT analyst, and they had been for some time. So I submitted my resume. Jonesy calls me, schedules an interview. Friggin', remember 2 years ago? I don't know if you remember this, but like a friggin' hurricane hit.
Yeah.
Yeah, it was the well, oh God, it was probably like August of 21.
Yeah.
And not like we lost power in the area, knocked out a lot of cell phone towers the day of my phone interview with Jones.
Okay.
So like I didn't have any cell phone service in my house. I drove like to basically to like the coast of Connecticut to get cell phone service. I'm parked on the side of the road with my hazards on, talking to Jonesy, and like we hit it off, and then like the rest was history.
That's
so,
awesome.
And then March 1st, 2020. The 1st of March 2022 was my first day.
That's
Yeah, so here I am.
That's a fitting story there at the end in terms of that is like the definition of the honey badger. You will do anything. You'll do anything.
Well, I don't know about anything.
Pretty much, but
I really wanted this
But it's
job.
awesome. No, I mean, like it just shows like the grind mentality, and it's one of the things I know Keith has mentioned many times, and you were recognized as at the company party at the end of the year, and I think. So again, for anybody who's at home who knows Rob at all, who's been following along, he's an absolute grinder, and you are a grinder, and he's excellent at what he does. And I think one of the big thank you, but one of the big things is around you have a process.
I do.
You have a process, and it's different.
It's very different.
And it's you know we have some slides that you know Seltz, we're going to pull up, maybe slide 2 there. Just for the folks at home, but I think you know it's a good transition to sort of because you do a phenomenal job of like many analysts here, or sector heads, but of taking your process in the REIT space, overlaying some of the quad dynamics, and then coming up with some key and good ideas, right? So,
yeah, well, I hope they're good. I guess if they make money,
I would, yes, if they make money, that's typically absolute returns is all Hedgeye Nation often cares about. But
well, I mean, I guess like I'm just going to speak to. I'm not going to go point by point.
No,
And by the way, like my process has actually like evolved over time too since I first made this slide.
Okay.
And part of it is like kind of embedding myself in Hedgeye or Hedgeye embedding itself in me.
Yeah.
But if I had to like summarize it, so like my space, first of all, it's huge. It's very broad and it's very deep. So like when I say broad, I mean there are over 200 equity REITs in the U.S. That doesn't count mortgage REITs or the other like traditional C corps that touch real estate, like the brokers, you know, other asset owners. And so it's a big universe, and I have my pick of the litter, and it's like when you think about that, and also it's typically, you know, REIT guys and girls think about dividing the world up into subsectors, and all those subsectors like tend to hit pretty much every part of the economy. So there's resi, split resi up and among traditional.
If I may interrupt,
Yeah, sure.
Seltz, can you pull up slide 4?
Oh, yeah.
Just pull up slide 4, and we'll come back to the process slide.
Absolutely.
Awesome. Yeah, I apologize for interrupting there, but this is a great slide to kind of help break down the subsectors.
And right, so like it's broad, it's deep, it touches every side, like part of the economy, and it's also like I think about it on a spectrum of duration, and what does that mean? And I won't list all the sectors, you can see them here, but so obviously like in, you know, commercial real estate or REIT real estate involves leases with tenants, and those leases have differing, like, you know, like shorter and longer durations depending on the subsector typically. If you were all the way on the short end of the curve, right, of that duration curve, you'd have Todd space where the leases reprice daily, and that's lodging. Slightly north of there would be storage because they're month to month. Like they theoretically roll month to month. You could like, you know, walk away from it. Take that all the way to its extreme, like the furthest long end of the curve would be like triple net, timber, hospitals, although they shouldn't be. We could talk about that. MOBs, you know, the most bond-like vehicles. Yeah. So like if you think about what that means, and this gets back to process, the way I think about the world is I actually start with the macro now. I didn't do this previously in my career. But like understand where we are in the quads and in the macro cycle, and think about like probabilistically where we're going based upon the macro team's work. It helps me take this really like wide top of the funnel and narrow it. So focus my energy on the sectors that are either, or at least theoretically, should or should not work in a specific quad, or like looking forward, given the conditional probabilities where we're heading, and thinking about key signals and all the above, and then understanding that, focusing my energy on certain subsectors, then like attack it from the bottom up and pick longs and shorts underneath that, and like typically, like and if I had to summarize the outcome. In order to go against what the macro is saying a certain stock and subsector should be doing, I have to have an enormous amount of conviction. Yeah. To the contrary, right? So like, let's talk about that. And this gets into the bottom. So where do I start the bottom up process? I think if you asked me that question, you know, 2 years ago, I'd have a very different answer than I do right now. The very first thing that I do, and I learned this through MPW. First of all, what's a REIT, right? Like a REIT is just it's a publicly traded private equity firm, essentially. They raise capital, they allocate capital to what should be the most accretive or like value enhancing, what the management teams think should be the most accretive or value enhancing opportunities. And then sometimes, depending on the subsector, there may be like an operating company tucked in that manages the real estate. There's some sectors that can't manage; they have to hire a third party. But you know, we won't get into the technicalities of that. But basically, it's dollars in, dollars out, and you are making a bet to some degree on the capital allocation abilities and objectives of the management team, who like theoretically should be investing alongside of you. So like if you think about that, like where's a good place to start? I start with a proxy. The first thing, and no one usually, like how many people read proxies?
No, you told me that was one of the things you told me.
Yeah.
Shortly after I joined, you're like, Proxies is my go-to. If you want to learn about a REIT and do it quickly, go to the proxy and read through it. Because it's going to give you a ton of insight as to where it's going, what the management is doing. And Celt's is on the switch today, baby. So the good example here is, this is the MPW.
So I'll tell you the story. So like how this evolved. And then, by the way, this is from our company meeting last year. Late last year, I presented this. But around this actually was this time. Well, it was crazy to think that's a year ago. Maybe like 11 months ago, we had just gone short, or recommended clients go short, invitation homes. So there were lots of client calls, particularly with hedge funds, on that name, because it was very controversial at the time. It still is in some circles, but like to some degree, it's worked out. It's, But what was interesting was that like over the course, and like we're always like socializing ideas, and we're talking with each other about different stocks. I mean that's what I do. I talk to clients about stocks, and I noticed a pattern over like a 3 or 4 week period.
Okay.
So I would say, really, it was like a 2 or 3 week period. I would say 4 clients, completely independent of one another, asked me in passing if I thought MPW would ever have to cut its dividend. And the first 2 times, first of all, at the time I said no. I'm like, look, I've heard of this company. I've kind of like loosely followed it. I'm aware of it. I know, I've heard people say what they say about it, or they're bold. It's very divisive, right? So like there's some that are very bullish. There are others who think it's like the worst thing ever. Be that as it may, like I didn't have an answer. So I was like, look, I don't know. First couple times I didn't think much of it, but then the 3rd or 4th time I'm like, okay, I gotta understand this. So on a Friday, I printed out the proxy statement, most recent 10K, couple of the supplementals, couple earnings calls, and I just took it home with me. And I also realized that there was, like, at the same time, around that time, a couple of Wall Street Journal stories. Like, there was one in February, and then I think one late in 21. But anyway, went home, kids went to bed on a Friday night, and I sit down at my computer. No, it was either Friday. I can't remember if it was a Friday, or it was either a Friday or a Saturday. I sat down, started reading the proxy statement, and before I knew it was 3 in the morning. So I started reading it at like 8 p.m. and before I knew it, and I was just like, oh my God, this is going to be a total trip. So maybe going back to this slide, like let's think about this a little bit. In general, management teams will do what they are paid to do, right? Like if you incentivize me to go out and pick long and short ideas, like I'm going to move heaven and earth to try to do that. Yeah. If you incentivize management teams to accretively grow cash flow in an economic fashion, in an economic fashion, they're going to go do that. Yep. Well, in this case, like I would make an argument that the incentives are just completely perverse, and you can see it like plain as day right off the bat. So like I looked at this and I knew right away that I was this was gonna be a problem. Yeah. And specifically, so like there are a couple things here that stand out. The first, look at the bottom of the page, 30% acquisitions. So like, think about that for a second. I saw this with Commonwealth REIT, that is now Equity Commonwealth. So Commonwealth was one of the Portnoy/RMR vehicles, total shit show. Basically what they did was, like, it was an externally managed REIT from RMR outside of Commonwealth, and Commonwealth paid management fees to RMR. So like that takes the place of the overhead, like the SG&A. And the way they structured the fee was on gross assets. Okay. So like raise $500 million in equity, go buy $500 million of real estate. But like, if you think about what that means, you're incentivizing the team to go out, not only buy anything, right, but pay the highest price. Right. Like,
and dilute shareholders.
Potentially.
Right.
So like, and I'm not saying MPW did this, but like in that case, the Commonwealth guys went out and bought a bunch of vacant buildings and blended it in with like the ones that were cash flowing. Right. So like, that's problematic, right? So like I saw this and I'm like, okay, these guys are literally incentivizing themselves to go out and buy, like I could buy $5 billion of hospital real estate tomorrow. You just need my signature. It takes no skill, right? Like, give me $5 billion, I'll find something, I'll freaking buy it. But like, you need something to moderate that. Like, you need a shareholder, at the bottom, there's a TSR modifier, but you need like true cash flow modifiers to rein that in.
Sure.
Like, go out and buy anything, but make sure it's economic. Right. Well, what did these guys do? The other highlighted sections, they used non-cash GAAP metrics as their modifiers. Well, if you go out and you sign a 25 or 30-year lease, or you do things like, I don't know, book 20 years of extension options before they're exercised into your GAAP, you can boost your FFO by that non-cash revenue by a large amount.
Right.
So like, again, I look at this, they're going out, they're incentivized to buy anything, and they're incentivized to strike really long lease terms, and then pull cash and stock comp out at the beginning of the structure, and leave the shareholders holding the bag at the end. Mm-hmm. Like, the shareholders are going to be the ones that have to ultimately bear the positives and negatives of this arrangement. Mm-hmm. So like, looking at this is a completely misaligned incentive structure. Mm-hmm. If you invest in this company, this management team is not invested alongside you. They are incentivized to pull value out up front, mm-hmm. and whatever happens to your potential detriment. So anyway, I start my process here and then go into like the more traditional analytics, whether it be valuation. We're very rate of change focused. So yep. Like the starting point for me is like, I look for inflection points in the rate of change, be it positive or negative, and hopefully front run that, as like Keith likes to say, and position ourselves accordingly. Now, what's interesting about this one is that like, look, if you lose 30% of your rent, that's kind of the definition of a negative rate of change. So so. Yeah,
so if you go from proxy, yep. And then REITs are a little bit more unique than say mm-hmm. other general sectors.
Definitely.
And that's where I think if we go from the proxy. And then, if you don't mind expanding, I think this is one of my, I'd say, second favorite slides
sure.
in this deck, because it really breaks down kind of exactly how you kind of hunt for ideas.
Yeah, sure.
And I think it'd be great to review that.
Yeah, sure. So, well, this slide really kind of looks at some of the things that, like, when I see it either is a red flag or a green light for me, and things that are very, very, like, idiosyncratic to REITs. So, what is a REIT? It's a capital allocation vehicle, but like in its essence, a REIT classification is just tax classification. It's a pass-through structure, and there are certain IRS rules that you need to meet, in order to not meet those requirements, and as a result, not pay corporate income taxes, pass all the income onto your shareholders who get taxed at the personal level.
Yep.
So there are things like income test, asset test. You can't own more than 10% of an operating company. Looking at you, MPW. It's a fun one.
Always comes back.
It's a fun one.
Always comes back.
Actually, you know what? Let's go for it. Yeah. They're buying back stock. They have JVs, a lot of them. A lot of the leverage is on balance sheet and not tucked away at the JVs, which is weird. They're trading well below NAV, although NAV is nonsense. They have poor earnings quality and they have excessive leverage, mm-hmm. and I think you could probably make a case that they are externally managed because the only winning constituency is the management team.
Right.
So actually, like in a weird, I wasn't planning on saying it, but you kind of check all these boxes. So like, I look at that, and I'm like, all right, well, you're on the short side. I don't even need to know anything else about it. Like, you're never going to be on the long side of my list if you check all of. But anyway, with that said, like, think about if you have to pay out 90% of your taxable income as dividends.
Yeah.
Almost by definition, you're limited in the amount of capital that you can retain. So like, think about a Disney, right? Like Disney will make $1 billion of earnings, and they'll spend some portion of that as capex, like $200 million. So they have $800 million left over. They'll service their debt. They'll pay a dividend. They have some surplus. Buy back some stock if we think it's an appropriate time to do so, right?
Yep.
In REITs, in the case of REITs, if you have any taxable income, you have to pay out 90% of that, which immediately, given that, like, you may have a capex obligation if you're not a triple net, and you have debt service, you have, obviously interest cost, which is part of net income, but there are you're limited, and dividends, right? So like dividends is the large. You're limited in the amount of capital. If the point is, if you buy back stock, you're stripping your available capital out of the entity. You're playing market timer. So like you as the shareholder, you're basically making a bet that management's a better stock trader than you are. I wouldn't make that bet. I would prefer you give me back the cash and let me do it. Do what I will with it. Like I would rather
invest it in higher quality real estate that fits your mandate, et cetera, et cetera.
If you can.
Yeah, if you can.
Like I would rather Keith get a special dividend and put it to work for me than like Ed Aldag. Buy back his own stock.
Yeah,
you know,
absolutely.
Like that's just me.
100%. And if we pivot slightly to like the long side, right?
Yeah.
In terms of things that you look for in, because again, many at home either don't short or aren't comfortable shorting, right? So
let's talk about some other triple nets.
But like REITs can be very attractive from a income stream, whether you're retiree or what have you. But
I'm like talking about shorts a lot because we're like short the world.
100%.
But let's talk about some
I understand
longs.
XLRE is negative. Is bearish trend at the moment, so that's a big thing for those at home, right?
Yep.
So it's the REITs or XLRE specifically from an ETF standpoint, bearish trend. So but however, it does because an ETF is bearish doesn't mean that some of the components inside of it can't be bullish trend and have good signal strength.
Well, let's talk about let's talk about some of the longs. So like if you look at the long side of my position monitor, you'll see longer duration names with like relatively high underlying credit quality and an ability to grow externally because they have their cost of capital. And what does all that mean? So I have several triple nets, so like Agree, National Retail Properties who reported this morning, Realty Income, Net Street. I want to talk about Net Street as a long in a second, but they all have an attractive cost of capital in the market. So in a world where like all of the short duration stuff, because we're in a quad 4 and the rate of change is rolling over, like earnings estimates are getting cut, you're up against this like negative rate of change profile. These guys can actually like accretively raise debt and equity and go out and aggregate portfolios of single tenant triple net lease properties. If they lose their cost of capital, like if you think about what that means, if you're a triple net landlord and you have like 2 to 3% escalators in your leases, you're capped as a grower. Like you're going to be growing well below average relative to the entire REIT space if you lose your cost of capital. If you have a cost of capital, you can effectively outpace the rest of the space in earnings growth. So like let's talk about Net Street for a second. Net Street, it's a SMID cap, so like there's some style factors that don't necessarily fit with a quad 4.
Okay.
But if I'm thinking about a tail long, so like let's trade trend tail, like
so 3 years or more.
3 years or more, or roughly 3
years.
Like as a fundamental analyst, you like to think about you tend to think about tail more than the other durations. But you look at Net Street, it's under levered, and it just had an upgrade in index inclusion, so a better equity cost of capital. So like what does that mean? It can flex its leverage up to the space's average, so dollars in, and it can more accretively raise equity, go out and aggregate single tenant net lease properties, and it's small, so it's starting off from a smaller base. That translates into, I think, over the next 3 to 5 years, like double digit to like low teen earnings growth, when the rest of the space will be growing mid to high single digits. So like if I'm making a tail bet, that's a great bet.
Yep.
Now, again, maybe not the best style factors near term, but like I high conviction, that's one of my favorite tail longs right now.
One to put on the watch list. Amazing. And something you just heard for this last half hour is the quad factor play a huge impact, right? In the back tests and everything like that.
And it's new, but for me in my process.
New for you, right? Which I know has been a huge value add in your space and becoming an even better analyst. And in terms of just being able to pivot and look at kind of go to those underlying subsectors that have a higher probability of succeeding or failing. Depending on which direction you're going.
That's right.
I think that's it's a huge component, and I loved the longs. quality, strong balance sheets. Those are two style factors that we do like typically in a quad 4 environment, which we're in right in this moment. So
maybe one more, corporate office properties trust.
Sure.
Another strong balance sheet, long lease term, like quintessential quad 4 long, right? Like it's the case where like you're for sure going to lose, at the very least, lose less money.
Amazing.
50% levered to the U.S. government, like those guys are never not going to pay. So it's like, we're thinking on the long side, we're thinking about losing less money, and on the short side, we're like trying to shoot the lights out.
And if you can long short, you can always go long a couple of the key underlying longs that you have in the individual names, and short the index or short the XLR ETF, which is, as I mentioned earlier, bearish trend. But that is today's signal. So might not be the case tomorrow, so just keep that in mind at home. And Rob, I just want to, I guess
my pleasure.
leave it with you. I think we covered a lot.
My pleasure.
Any kind of key theme here going into kind of post earnings that you might want to kind of leave the folks at home with?
Into earnings or coming out of
Or
earnings?
I mean, into coming out, whatever you think.
Maybe two. I think that like a lot of REIT investors are still overexposed to resi.
Sure.
And underestimating the slowdown there. And on the long side, I'm going to say something a little, controversial. I think there's going to be data centers. Data centers have been a very So and by the way, very, very, very public short theses on the data centers, and they've worked, and many of the points are right. I've been digging into the space. I think that like distinctions need to be drawn between and among the data center operators, and there's one that's potentially interesting on the long side. I don't want to get like too far into it, but like it has many of the things that you would want to see right now. So like it self-funds. It doesn't rely on external capital. The return profile is much higher because of the nature of the differences of its business. It's not well understood, and I'm still trying to like fully understand it. But what I do see is the math and the numbers, and I think that some people are treating it in too draconian a fashion, and there's going to be a point in time where it's really going to work. So anyway,
awesome.
Just something to look out for.
Awesome. No, I like how you teased that out there. You're a real pro. So if you like what you heard here today, you can always follow Rob on Twitter. That's Hedgeye REITs.
Yeah.
And his Sector Pro product is also available for those at home as well. So Hedgeye Nation, thank you for joining in this week. Next week, I'll be sitting down with Emily Evans, the healthcare policy sector head.
That'll be a fun one, and not at all controversial.
No, not at all. So it should be a good one.
You guys think I'm tough.
Yeah, exactly. It's one that a lot of folks have been looking forward to or asking me for. So we got Emily next week, which is going to be great.
Yeah.
Mister,
cool,
thank you, sir.
Anytime, man.
Hedgeye Nation, keep rocking out there. Cheers.